everyone. Welcome to the Property Wealth Podcast. Today, we're diving into a really exciting topic that's been gaining a lot of traction lately. Short-term rental arbitrage, which is all about leasing and subletting properties.
Yeah, it's an interesting strategy that can really open up some doors for people looking to invest in real estate without having to buy a property outright.
Exactly. It's like a way to tap into the booming short-term rental market without the hefty price tag of owning multiple properties.
Right, and it's especially appealing for folks over 40 who might be looking for new ways to diversify their income streams or just get started in real estate investing.
Absolutely. So today, we're going to cover the ins and outs of how to find the right leases, what to look for in a property, and some potential pitfalls to avoid.
And we'll also touch on how to create a smooth transition from leasing to subletting, which is crucial for making this strategy work.
Yeah, and we'll share some real-life examples that can really help paint the picture of what it looks like in practice.
So if you're curious about how to leverage this strategy to build long-term wealth, stick around.
Let's jump right in. What's the first thing someone should consider when they're thinking about getting into short-term rental arbitrage?
So, Sarah, when we talk about short-term rental arbitrage, it's not just about the potential for income. It's really about creating a financial safety net, especially for those of us over 40.
Absolutely, Mike. It's a time when many people start thinking about retirement, right? And with the way the economy's been shifting, that can feel pretty daunting.
Exactly. With inflation on the rise, traditional savings accounts aren't cutting it anymore. People are realizing that they need to think outside the box, or, outside the traditional investment strategies.
Yeah, and I think that's where short-term rental arbitrage comes in. It allows folks to leverage existing properties without having to buy them outright. So it can be a lower barrier to entry for those looking to build wealth.
Right. I remember chatting with a couple, let's call them Tom and Lisa. They were both in their late 40s, and they had been saving for retirement but felt like they needed something more dynamic.
What did they end up doing?
Well, they decided to take advantage of a property in their neighborhood that had been sitting vacant. They negotiated a lease with the owner and then turned around and listed it on platforms like Airbnb. In just a few months, they were able to cover their lease and even make a profit, which they then put toward their retirement fund.
That's amazing. It sounds like they found a way to not only secure their current financial situation, but also increase their future wealth.
Exactly. And, it's not just about the immediate income. For many people over 40, there's a real emotional aspect to financial security. It's about not just surviving in retirement, but thriving, right?
And that emotional security can be so powerful. Knowing that you have a steady stream of income can really alleviate some of that anxiety that comes with thinking about retirement.
Totally. And look, it's not just a safety net for yourself. It can also help with wealth transfer to your family. If you can build a portfolio of properties, you're potentially setting up your kids or grandkids for a much more comfortable future.
That's such a great point. Imagine being able to hand down not just assets, but also the knowledge of how to manage them.
Right. I think about a guy named David who was in his early 50s. He started exploring short-term rentals and ended up getting his teenage son involved in the process. They worked together on managing the listings, and it became this bonding experience. Not to mention a way to teach his son about financial responsibility.
I love that. It's like they're building a legacy together. And with the current economic trends, it seems like diversifying income streams is becoming more important than ever.
Absolutely. With the job market being unpredictable, having multiple streams of income can provide that extra layer of security. If one source dries up, you have others to fall back on.
And, with the rise of remote work, people are more mobile than ever. That means short-term rentals can cater to a wider audience. Business travelers, families, you name it.
Exactly. And this flexibility can be a game changer. For instance, a friend of mine, Anna, she started renting out her home while she traveled for work. It covered her mortgage while she was away, and when she returned, she still had a property that was generating income.
That's such a smart way to utilize what you already have. And it's also a way to take advantage of current market shifts.
Yes, and let's not forget about the potential tax benefits. Short-term rentals can sometimes offer deductions that you wouldn't get with a traditional rental. It's worth talking to a tax advisor about how to maximize those benefits.
That's a critical point. I think a lot of people overlook the financial advantages that can come with short-term rentals, especially in the context of rising living costs.
Right. And, the fear of making a wrong investment can keep a lot of people from diving in. But short-term rental arbitrage, it's often less risky since you're not tied down by a mortgage and can adjust your strategy as needed.
That's so true. You can experiment with different properties and locations without the long-term commitment.
Exactly. And if one place isn't performing well, you can pivot. That flexibility can be incredibly valuable, especially as economic conditions change.
And I think it's also important to highlight that it's not just about the numbers. There's a lifestyle component too. Many people find joy in hospitality, meeting guests, and creating memorable experiences.
Absolutely. I know a woman named Clara who turned her short-term rental into a passion project. She loves decorating the space and connecting with guests from all over the world. It's more than just income for her. It's a way to share her love for her community.
That's wonderful. It's like combining financial strategy with personal fulfillment.
Yes, and all of this leads us to the core strategies that can help anyone, especially those over 40, to navigate the short-term rental landscape successfully.
Exactly. So let's get into those strategies.
So Sarah, let's dive into the core strategies for short-term rental arbitrage. A lot of people might wonder, where do you even start with this?
Right, I think the first step is really understanding the lease terms. You want to make sure that the property owner allows subletting, right?
Exactly. Always read that lease agreement carefully. If subletting isn't mentioned, you might want to ask the landlord directly. Some landlords are open to it if you present it well.
Yeah, and then there's the financial side to consider. It's crucial to run the numbers. I often recommend using the 1% rule as a quick gauge.
Oh, definitely. So the 1% rule means that your monthly rent should not exceed 1% of the property's purchase price. For example, if you're looking at a property worth $200,000, your monthly rent should ideally be around $2,000.
That's a good guideline. And if you can get the rent significantly lower, that gives you more room to make a profit, right?
Exactly. When you're considering potential rental income, you also want to factor in the occupancy rate. In popular areas, a 70% occupancy rate is pretty standard.
So if your nightly rate is, say, $150 and you're booked 21 nights a month, that's $3, $150. If your monthly rent is $2,000, you're looking at a nice profit margin.
Right, and don't forget to subtract your expenses, like utilities, cleaning fees, and maintenance. A good rule of thumb is the 50% rule. Half of your rental income goes to expenses.
So if you're making $3, $150 a month, you should expect to pay about $1.575 in expenses. That still leaves you with $1.575 as profit, which is great.
Exactly. But it's important to be realistic. Some months might be slower, especially in off-peak seasons.
True. And that's where having a financial cushion really helps. You don't want to be caught off guard if your occupancy dips.
Right. Another thing to consider is the types of properties you're looking at. Some properties are naturally better for short-term rentals, like those near tourist attractions or business hubs.
Absolutely. Properties with unique features, like a hot tub or a fantastic view, can command higher nightly rates too.
And then you have to think about the location. Markets can vary widely. A property in a busy city can yield a much better income than one in a rural area.
So let's say you're focusing on a city like Austin, Texas. You'd want to research the most popular neighborhoods. Areas close to downtown or the university could be prime spots.
Exactly. And tools like AirDNA can provide valuable insights into average daily rates and occupancy rates in those neighborhoods.
That's a great resource. And when you're evaluating properties, a checklist can be super helpful. What should that include?
Well, you should definitely check the condition of the property. Look for any necessary repairs or upgrades.
And then there's the market analysis part. Research what similar properties are renting for in that area.
Right, and also consider how much time you're willing to invest in managing the property. If you're doing it all yourself, that's a lot of work.
Yeah, but some people might prefer to hire a property management company to handle the day-to-day stuff.
That's true, but you want to factor in their fees, which can range from 10% to 20% of your rental income.
Definitely something to keep in mind. Now let's talk about financing options for these properties. What do you recommend?
Well, many investors use conventional loans, but you can also look into options like hard money loans if you need to move quickly.
Hard money loans can be great for short-term projects, but the interest rates are usually higher, right?
Right, they can be, but the speed of funding can sometimes make it worthwhile. Just know your exit strategy.
That makes sense. Then for those just starting out, using personal savings or partnering with someone can also be an option.
Exactly. Joint ventures can reduce your financial risk, and you both bring your strengths to the table.
So if someone is looking to jump into short-term rental arbitrage, they really need to be thorough with their research and planning.
Yes, and keep an open line of communication with the property owner. Building a good relationship can make a big difference.
And don't forget about the importance of marketing your rental. High-quality photos and a solid listing description can attract more guests.
Right. A well-staged property can really stand out. Consider investing in professional photography.
And utilizing platforms like Airbnb and Vrbo effectively can really help get your property noticed.
Absolutely. But remember, being responsive to inquiries and maintaining high ratings can significantly impact your success.
So, with all these strategies in mind, what do you think are some common pitfalls to watch out for?
That's a great transition. One major pitfall is underestimating the time commitment involved. It's not just about collecting rent.
Right, there's cleaning, maintenance, and dealing with guest inquiries.
Exactly. And another common mistake is not factoring in seasonal fluctuations. You might earn a lot in peak season, but struggle during off-peak months.
That's so true, and not keeping up with local regulations can lead to hefty fines. Always check on zoning laws and short-term rental permits.
Yes, compliance is crucial. And lastly, some investors might overlook the importance of good customer service. Happy guests lead to positive reviews, which is key in this business.
Well, that's a great note to wrap this section up on. Understanding the strategies, the numbers, and the importance of service can really set you up for success in short-term rental arbitrage.
So, one of the biggest pitfalls I see people falling into with short-term rental arbitrage is definitely over-leveraging. It's just so tempting, right? You see that potential for cash flow and think, let's go all in.
Absolutely. I mean, it's like you start to see those dollar signs. But then, when the market shifts or you have unexpected expenses, it can really turn into a nightmare.
Exactly. I had a client once who jumped into a deal thinking they'd be raking in cash. They took on multiple leases at once without really vetting the properties or the area. And then, bam! A few months in, they realized they were way overextended. The tenants weren't booking as much as they had hoped.
Oh no, that's tough. So what happened to them?
Well, they ended up having to find a way to get out of those leases, which was a whole other headache. They lost money on the deal, and it affected their credit for a while, too. It was a tough lesson.
I can imagine. It's so important to have a solid financial cushion, right? Like knowing your limits before diving in.
Exactly. And speaking of limits, bad tenants are another huge issue. You think you've got everything covered, but sometimes people don't realize that the tenant screening process can't be skipped.
Yeah, I mean, it's like you want to fill those vacancies fast, so you might overlook some warning signs, right?
Right. I had another client who didn't do proper background checks on a couple of tenants. They seemed great at first, but then they started throwing wild parties, and they were late on rent every month. It turned into a real mess.
Wow, that's a nightmare. So how do you spot those red flags early?
Well, for starters, always check references thoroughly, and don't just take their word for it. Call past landlords. Look for red flags in their rental history. Also, if they're evasive or hesitant to provide information, that's a sign too.
That makes sense. It's all about doing your homework beforehand, right?
Exactly. And another thing people often ignore is cash flow. They get so caught up in the excitement of the property itself that they overlook the numbers. You really need to know your expenses versus your income.
Right, like what could go wrong if someone doesn't keep an eye on that?
Well, I had a friend who thought he could just charge a premium because it was in a tourist area, but he didn't factor in the costs of utilities, cleaning, or maintenance. After a few months, he was shelling out more than he was bringing in. He had to adjust his pricing, and it was a scramble.
That's so important. You really have to have a clear picture of what your cash flow looks like. So what do you suggest to stay on top of that?
Regularly review your finances, set up a budget, and use a spreadsheet or an app to track income and expenses each month. It doesn't have to be complicated, just consistent.
Yeah, and I think people can get overwhelmed by the numbers, but it's really just about keeping it simple, right?
Exactly. And then there's the whole thing about timing the market. People think they can time it perfectly, but the market can be unpredictable.
I've heard that so many times. Like, waiting for the perfect moment to invest can really lead to missed opportunities.
Yep. I had a client who kept waiting for prices to drop, and in the meantime, they missed out on several great properties. By the time they decided to jump in, prices had risen, and they ended up paying a lot more than they would have if they had acted sooner.
That's a tough lesson. So what's your advice for someone who's stuck in that mindset?
Focus on the long term, not just the market fluctuations. Look for properties that fit your investment strategy, regardless of short-term trends.
That makes a lot of sense. So it's really about finding the right property that fits your goals, not just what's happening in the market at the moment.
Exactly. And let's not forget hidden costs. Those can sneak up on you. People often underestimate things like maintenance, property management fees, or even local regulations.
Oh, for sure. I've heard stories where people bought properties thinking they were in the clear, only to find out they had to pay for permits or codes compliance.
Right, and I had a client who didn't factor in the cost of property management. They thought they could handle it all themselves, but once they realized the time commitment, they ended up hiring a manager, and it cut into their profits significantly.
So it's really about doing that initial research, huh? Understanding all the costs involved before making a move.
Exactly. I always recommend creating a detailed budget that includes all potential expenses. And, having a bit of a buffer for unexpected costs can save you a lot of stress.
That's a great tip. So for someone who's worried about making these mistakes, what can they do to recover or avoid them altogether?
Well, first and foremost, education is key. Take the time to learn, whether through books, podcasts, or even local real estate investment groups. Surround yourself with experienced investors who can offer advice.
And maybe even seek out a mentor, right? Someone who's been through it all and can guide you.
Absolutely. And don't be afraid to ask questions. If something doesn't feel right, trust your instincts. And remember, the goal is to build wealth over time, not to rush into decisions.
Such wise words. It's all about being strategic and patient in this game.
Exactly. And, every mistake is a learning opportunity. Just stay focused on your long-term vision, and you'll find your way.
Well said. I think that gives our listeners a solid foundation to avoid those common pitfalls.
Yeah, and hopefully inspires them to take the next steps with confidence. All right, so let's dive into some immediate steps and tools that our listeners can use today to kick off their journey in short-term rental arbitrage.
Yeah, I think that's really important. People often feel overwhelmed, but it doesn't have to be that way. What's the first thing they should do?
Well, the first thing I'd recommend is to start by researching your local market. Apps like Zillow or even Realtor.com are great for getting a feel for rental prices in your area. You can compare what you might pay in rent versus what you could potentially earn through short-term rentals.
Right, and it's not just about the numbers. It's also about the demand in your area.
Exactly. You can use platforms like Airbnb or VRBO to see how many listings are available in your neighborhood and what their occupancy rates look like. That'll give you a better idea of whether it's a viable area for short-term rentals.
And once they've done some of that research, what's next?
Next, I'd suggest checking out the Bigger Pockets calculator. It's a fantastic tool for analyzing potential deals. You can input your expected expenses and income to see if it makes financial sense.
Speaking of expenses, what about tools for estimating those costs?
Great point. Rentometer is another useful tool. It helps you understand fair market rents based on the area and can help you figure out if your expected income aligns with local norms.
It sounds like these tools really help paint a clearer picture of what to expect.
They definitely do. And don't forget about your local MLS or multiple listing service. If you can get access to that, it can provide invaluable data on property sales, rental rates, and trends in your area.
Yeah, having that kind of data right at your fingertips can make a big difference. What about habits they can start forming?
I'd say start small. Maybe commit to analyzing one deal a week. Just set aside a little time each week to look at different properties and practice your analysis skills.
That's a manageable way to build confidence without feeling overwhelmed.
Absolutely. And joining a local real estate meetup can be incredibly beneficial too. Networking with others who are in the same boat can provide support, insights, and even potential partnerships.
So true. You never know who you might meet and what opportunities could arise from those connections.
And don't overlook the value of continuous learning. There are some fantastic books out there on real estate investing and short-term rentals. One I recommend is The Airbnb Advantage by Rachel O'Meara. It's packed with insights and practical tips.
I love that. And there are also podcasts that can provide a wealth of information.
Definitely. The Bigger Pockets podcast is a must-listen. It covers a lot of ground on real estate investing and often features guests who have succeeded in short-term rentals.
Those are some solid resources. It sounds like there's a lot of support out there for newcomers.
For sure. Remember, it's about starting where you are. You don't need to know everything before you begin. Just take those first steps.
And as they progress, they can adjust their strategies based on what they learn along the way.
Exactly. It's all a learning process. Stay curious, keep asking questions, and don't be afraid to pivot if something isn't working.
So with these tools and strategies in hand, our listeners are well equipped to take their first steps into short-term rental arbitrage.
That's right. It's all about action. So those are some practical first steps. Now let's bring this all together. So as we wrap up today's episode, let's quickly recap some key takeaways about short-term rental arbitrage.
Yeah, absolutely. First off, it's all about understanding the lease agreements, right? Knowing what you can and can't do with a property is crucial before diving in.
Exactly. And then there's the importance of choosing the right location. You want to pick areas that attract tourists or business travelers. That can really make a difference in your occupancy rates.
Right, and don't forget about the financial aspect. You really need to crunch the numbers. Make sure the potential income justifies any upfront costs. It's all about that cash flow.
And let's not overlook the power of good property management. Whether you're doing it yourself or hiring someone, keeping your guests happy can lead to better reviews and more bookings.
So true. Positive guest experiences can really boost your reputation in this game.
You know, for anyone over 40 looking to build wealth, real estate can be such a solid avenue. It's not just about making money. It's about creating a legacy, building something for your future.
Exactly. It's a long-term investment that can provide financial freedom down the line. Just take it step by step and you'll see the rewards.
And if you found this episode helpful, we'd love for you to like, subscribe, and drop a comment about your biggest takeaway or any questions you might have.
Yes, and don't forget to share this episode with someone you know who's over 40 and interested in property investing.
Next time, we'll dive into the trend of midterm rentals. Those 30 to 90-day stays. It's becoming a big thing, and you won't want to miss it.
So until then, keep investing in your future. And remember, every step counts.
Take care, everyone.
Bye for now.